Today we're talking about contracts for difference and the UMA interpretation of this and kind of the products that we can build using this primitive. This is a pretty simple concept at its base layer, but it can get pretty complicated when you start layering on lots of stuff on top of it. So before we start, I just wanted to ask Matt and Kevin and everyone who has more information about this than me and more experience with these kinds of products, please feel free to chime in and give input on anything that I either say wrong or explain badly. I think this should be as as many voices as possible. I think will help with explaining some of the more complicated concepts. So basically what we're going to talk about today is we're going to start talking about traditional CFDs very briefly. We'll look at the UMA CFD implementation. We'll very briefly look at some of the code and how simple that is. And then we're going to dig into the four main use cases that we've got for CFDs, which are binary, binary payouts like betting markets, linear CFDs, covered calls, and range bonds. And then we'll dig into some of the complexities and difficulties with using CFDs in production and some of the difficulties when it comes to market making them. So to begin with, in traditional finance, CFDs are basically a speculative tool that lets you take an opinion or a stance on the price of an asset without needing to hold the asset. And normally this is traded against the counterparty who will market make the other side. And basically in a CFD, you agree to exchange the difference in price from one asset on an asset over a period of time. And that basically can look something like this, where at a particular point in time, you enter into an agreement with a broker, and at the end of the settlement, at the end of the contract's lifespan, whatever the price has moved, you net the difference on that asset. And what's cool about this is, firstly, you don't need to actually own the asset. There's an implicit leverage also from this trading, because you don't need to put up the full price of the asset you're speculating on. It's also very easy to short sell because you just need to take the other side of the trade and the broker can take the long side. CFDs are illegal in the US, mainly because they're the regulation around them is pretty vague, and also they're really difficult to trade in a profitable way. I read this statistic that said that 90% of retail customers lose 90% of their money in the first 90 days of trading CFDs, which is pretty crazy. And yeah, so they're not you can't trade them in the US, but in Europe and in other places, they're pretty popular on places like eToro, for example. All of their products are CFDs.
Cool.
And yeah,
just for context on that is not a function of the actual product or contract itself. It's just the brokers that have been offering CFDs use them for all sorts of shady shit traditionally. So it's yeah, I just want to provide some context that it's not a function of the agreement. It's just a function of how they've been sold and brokered historically.
Cool. Okay, that's good context.
Hey, just so I understand, an example: Apple stock is $20. It expires at $25. If I'm long, I get $5. If you're short, you lose $5.
Exactly. So we trading on the difference between the start of the contract and the end of the contract.
And Tom, to go deeper on that, that is identical. What you just described, it's identical to buying a share of Apple stock at $20. If it costs $20, and if it goes up, you make $5, and if it goes down, you lose $5. The reason why, so CFDs are popular in Europe and other places that don't have direct access to US stock market. That's one reason why they exist. The reason why people lose a lot of money on them, what's the difference between that and the traditional stock market? The reason is that a lot of the brokers offer them with insane leverage. So really high leverage on this. Instead of just buying one share with $420, you lever up, and think BitMEX style, high leverage stuff.
Yeah.
So yeah, the generic unlevered version of a CFD is just designed to mimic buying a stock or other asset.
Yeah, and I think a really important detail that you said there, Hard, is if you can't access the actual asset, right? Because then it is by definition a synthetic, and that's why it works really nicely for what we're trying to build here. So we can mimic this price exposure and assets that you wouldn't be able to access. Obviously, we couldn't hold the underlying. Okay, so we're now going to look at the UMA CFD and kind of what we've built and what we've conceptualized. So some of the goals around this design is first and foremost for it to be as simple and lightweight as possible. And obviously, like, we need to err on the side of simplicity and like minimizing complexity in everything we build to make it as easy to understand and cheap to deploy and use. And I think we really achieved that really nicely with this product. Like, the total contracts are like less than 200 lines, which is pretty awesome. Also, I think extendability is very important, and you know, you want to enable anyone to create any kind of financial product using this base primitive, and they should be able to generalize like all the different components of this to build out any kind of product. And it also should leverage the optimistic oracle, so we don't have to go and do lots of governance for adding price for settlements and adding different identifiers and things like this. The big pro of CFDs, and you kind of get this by definition, is that they're non-liquidatable. And this means we don't have to run any kind of off-chain infrastructure. And there's the risk for the sponsor is better known, right? Like, you know the risks you're taking on, and there's like less market volatility risk. Like, you know when you sponsor a position or when you mint, you know the risks that you're taking on. So I think these are some of the goals that we set out with when originally designing the CFD. So this is the basic structure of the smart contract.
Chris, can I add one more thing there too? I hate to keep interrupting, but the one other thing that I just want to highlight for everybody is, like, the non-liquidatable bit is not what a traditional or typical CFD looks like. Mm-hmm. So a typical CFD is something where there are liquidations, where you do need to add margin, there are margin calls, there's all those concepts. What we're doing here is we're capping the payouts. We're saying there is a capped upside and capped downside, and hence there is no concept of liquidations, which is also why we aren't calling this a CFD contract. That's why we renamed it, because I think actually calling it a CFD will confuse other people, because that's not the way it looks like in traditional finance use cases. So just one nuance there.
Very true. Okay, so contract architecture, very similar to how we've got some of our other financial products. So we have a library, which is used to create CFDs. And this CFD basically will create a long and a short token, which we'll talk about in a bit. But the basic idea is that you can tokenize the long position the way you would with one of our like EMP contracts, where you have a token to represent the long side. And the very important detail of the CFD, which we'll dig into a lot later, is this tokenized short side. And the fungibility that you get on the short side is a pretty powerful concept, which we'll talk about a bit more later. We use the optimistic oracle for settlement, and if there's any disputes on that, then we go to the DVM for arbitration. I think that should be the official logo for the optimistic oracle as well, by the way, just saying. Nice. Okay. Okay, so let's dig into what this actually looks like within that CFD contract. So we have a combination of a long token and a short token to represent the two sides of the trade. Sponsors, and maybe a better word for them is minters, which we refer to them as later on, and we'll talk about why minters is a better word. But anyway, so the minter can deposit collateral into the contract and actually use this to mint these long and the short tokens. So if the minter wants to sell the long side, they can deposit that into an AMM, and someone else could buy that. And you kind of have a similar risk profile then to what we have in our current products, where like the token sponsor or the minter is holding the short exposure, and people that buy the token from the AMM have this long exposure. And that's basically how you would long one of these kinds of products, is buying the long token from a minter, from an AMM, and to get exposure from the long side. So the basic way that this flow would work is that the minter would deposit collateral, they would get back long tokens and short tokens, and those are minted in equal number. And the reason that is done is because you actually want the risk profile at minting to be neutral. So if you actually create a position, you deposit a certain amount of collateral, you get back both tokens, you're not necessarily long or short, just like you would be in an EMP if you have a position and you haven't sold any tokens. You could then choose to sell the long side of this token, and the person who buys it will then have long exposure. And because you're down the long side as a minter, you're down the long side and you still hold the short side, you're then short this product. And obviously there's like lots of different ways to market make this or to sell these products. You could in theory, list both the long and the short sides on an AMM. Maybe there's more demand for the one side than the other. So you're going to have some kind of weird exposure that's like, some of the longs get sold, some of the shorts get sold, and you have some kind of risk profile in the middle. And yeah, market making these, I don't think is like a really solved problem, and we'll discuss some of the complexities later on. But yeah, that is something to consider, that it's pretty difficult to market make. So yeah, that's the basic flow when we've got these two tokens. So
Chris,
yes.
In the example with the Apple stock thing, like, let's say they are trading at $25. Even if you minted some later on down the line, you're going to get half and half of these long tokens and short tokens. And then you would just, like, and they'd sort of be neutral, right? Like, they'd cancel each other out until you sold one of them. Or, yeah, right, until you sold one of them.
Exactly. Exactly.
Okay.
And what we'll look at now is like the ratios that define like how much collateral you put in versus how much tokens you get out. Like that is independent of anything until settlement, right? Like you always get a fixed number of long and short tokens for each unit of collateral, and you can always redeem those. So I might be jumping the gun a bit, but it remains like as a fixed ratio until settlement, and then at settlement is when actually like the payout between long and short defines how much collateral you can redeem for. But yeah, I think that'll become a bit more clear as we go into the actual specification. Okay, so like I just said now, pre-expiry, so like from when the contract's deployed up until expiry, minting and redemption happens with equal numbers of long and short tokens. You have to mint and redeem in pairs, and it has to be equal amount for that exact reason that you just raised now, Clayton. You want the net exposure for the token sponsor to be neutral when they mint. And the amount of collateral that they require to mint this pair of tokens, we define this with a variable called the collateral per pair. So if you said that to mint tokens in the contract, you need to put in, let's say, 1 collateral per pair. In the Apple stock case, we could say, you need to put in 1 USDC to mint 1 long and 1 short CFD token. And at any point pre-expiry, you can use this collateral per pair to work out the exchange rate between a pair of long and short tokens if you're redeeming, or collateral to long and short tokens if you're minting. And then at settlement, we use the price that comes back from the price source to actually inform how much of this collateral per pair is allocated to the long side or to the short side. So the basic way that this works is when you're minting tokens, you're going to deposit collateral, and the amount of tokens that are created is basically calculated as the collateral used divided by the collateral per pair, or equally, the collateral used is the tokens to create times by the collateral per pair. So in the example we have here, we're creating like some fictitious contract. Collateral is WETH, and the collateral per pair is set to 0.1. So if you want to make 100 tokens, you would deposit 10 WETH, and you would get back 100 long and 100 short tokens. And then if you want to redeem these tokens pre-expiry, you can always redeem that pair back for the collateral that you deposited. So your 100 long tokens could be redeemed back for the 10 WETH, and the collateral to redeem very simply is just the tokens burnt times by the collateral per pair. And this number, collateral per pair, we'll see that throughout this presentation, because it's like a fundamental component in how all these things are calculated. And then finally at expiry, we basically define this number called expiry percentage long, and we'll get to how that's calculated later. But for now, just consider that it's basically how much of the collateral per pair is redeemable for the long tokens versus the short tokens. So this number will be anywhere between 0 and 1, where if it's at 1, then each long token is worth a full amount of collateral per pair. If it's worth 0, then each short token is worth a full amount of collateral per pair. And anywhere between 0 and 1, you're basically shifting the amount that's redeemed for each kind of token. So that's a bit confusing, and I think we'll see later on that the reason we use this representation is it lets us generalize this product to encompass any kind of primitive. because all you need to do basically is modify how you calculate this expiry percentage long, and then you can encompass any kind of product. And the equation that I have down here basically says like the collateral redeemed is the number of tokens that you're burning times by the collateral per pair times by the expiry percentage long for the long side. And the short equation is exactly the same, except it's 1 minus expiry percentage long. So in the example where it's 0.75, this second term is going to go to 0 because there's no short tokens to burn in this example. And you will just have the number of long tokens burned times by the collateral per pair times by the expiry percentage long, and you'll get out amount of width. So yeah, we'll see how this all fits together later on when we actually dig into the different like use cases. But yeah, for now you can just think about this as being a representation of the redemption value of long versus short tokens. Any questions or comments before I go on?
Yeah, Chris, I might be jumping the gun here, but when we use the example of a $20 Apple stock in this, like, and let's say that we wanted to have a max up and downside of $10, which I'm assuming is something we have to define from the starting point, right?
So that's a linear CFD, yeah. Okay.
So does this collateral per pair thing mean that if we wanted to set these maxes at 10, does that mean we would use like 10 USDC per pair, or am I kind of jumping the gun or confusing things? Does that factor in here?
You don't actually need to relate the collateral per pair to the bounds in the linear case. Like you could have any combination. So you could have like, 0.1 collateral per pair. Each token will just be worth a very small amount, or it could be like 1,000 collateral per pair. Or all that matters is in the case that in the numbers you said now. So let's say like the Apple stock is trading at $20. The lower bound is $10 and the upper bound is $30. If at settlement, the price is $20, right? So it's right in the middle of the range, then the expiry percentage long will be 0.5, right? So the long tokens equal the short tokens equal to half of the collateral deposited, and together it's equal to full amount. And then like as we move closer to the upper bound, right, closer to 30, then that number is going to go up because more collateral is redeemable for the long side, and as we go down, more collateral is redeemable for the short side, right? So the number will decrease, and then the short tokens are worth more. But yeah, but that's just the linear case, right? So there's like all these different products we could build, and it all just influences this number, expiry percentage long. Okay, so I think,
Chris.
Yeah, Vari?
Could I just ask, pre-expiry, you have to redeem them in pairs. You can't redeem them singly. It's only at expiry you can redeem only a long or only a short.
Correct. Yeah.
Chris,
Okay.
why are there two tokens? Like, what was the alternative design?
Well, you need a way, like one of the key components with this is to make the short side fungible. And that's partially of what I described on this slide. So you no longer actually have the notion of a position, right? Like there is no longer a sponsor necessarily. Like the long side and the short side are equally fungible. And you could literally just take those short tokens and send them to someone, and they now own the position. So the contract doesn't need to store any like internal data structures for positions. It's literally just token balances of long tokens and token balances of short tokens. And those things together equal like the total risk exposure on the two sides. So I think the real goal, the real reason why you tokenize the short side is so that it becomes fungible. And that has like a whole bunch of really interesting properties, you know, where you can actually like sell short exposure to an identifier without needing to do anything weird.
Actually, Chris, it's worth reminding us all like the path how we got here, right? Because we were building these KPI options and we were hacking the EMP so that it had like 100% collateralization. It was just fully collateralized on the short side. And then we're like, okay, we're kind of hacking the EMP to do this thing. And it's kind of messy. And let's build a simpler version of this. And then, you know, Matt and I actually realized we're like, oh shit, right? Like, well, if all the collateralization on the short side of the EMP is all the same, that should be a token then. It's sort of silly if we don't make it a token. And we're like, okay, yeah, that makes sense. So that's the path of how we got here, where we were like looking at these non-liquidatable EMP use cases. And we're like, well, if they're non-liquidatable, The collateralization on the short side is all the same. It's fungible, therefore we should just make it a token.
Yeah, but I think what's really important to note is that only works if all of the short side is the same, right? All the sponsors have the same profile. So in a normal EMP, you know, different sponsors will take on different risk tolerances. They want different collateral ratios, whatever the case is. You can't then like tokenize that. Just like you can't tokenize like a MakerDAO vault, right? Like different vaults have different risk characteristics and you can't tokenize them. But if we do it this way, then all the risk is the same. Everyone's long and short tokens are equal. And I think that's really key.
And they're equal because you hard code the collateral per pair ratio, right?
Exactly. Yeah, exactly.
One thing I wanted to add as well is like this is the exact same logic that goes into Uniswap v3. Like there's been a lot of discussion about why Uniswap v2 positions are fungible, or Uniswap v2 LP tokens are fungible, but Uniswap v3 ones are not. And it's the same thing Chris just mentioned, right? That the risk properties of Uniswap v3 positions are all different because you can parameterize it yourself. Like you get to say, oh, I want this range and I want this particular, like, I want this range and I want this amount of capital or whatever. And you couldn't do some of that in Uniswap v2. So everybody's position was effectively the same. So the LP tokens all were redeemable for the exact same amount of collateral. And as the price moved, the same thing happened to them. And so the same thing for our EMP, right? As your risk properties are all different because you have different amounts of collateral.
Exactly. Okay, so we can now look at some of the functions that this contract has. And the contract only has four functions, which is pretty cool. So the first one is create, which the minter uses to deposit collateral to mint an equal number of long and short tokens, like we discussed. And the amount of collateral that they need to deposit is defined by this collateral per pair variable. The second method that we've also discussed is redeem. And that's where you take back a pair of long and short tokens and you exchange it for collateral. And the ratio that you do this is collateral per pair times by tokens to redeem. After the expiry timestamp, just like with the EMP, there is an expire method that can be called that requests a price from the optimistic oracle. So at that point in time, the optimistic oracle will have a price included in it, and then anyone can propose the price. How we do bonding and rewarding in the optimistic oracle is still a bit of an open question, but the current pattern is that the deployer will pay for the reward that goes to the optimistic oracle. And then once the optimistic oracle has returned, then token holders can call settle. And when they do that, they can specify how many long and how many short tokens they want to burn in exchange for a commensurate amount of collateral. And that is like literally just the equations we looked at earlier on, where you take the price, you calculate that expiry percentage long, which we'll get into in a bit, and then you combine that with the number of long and short tokens that are being redeemed. So,
sorry, real quick. So if I approach this opportunity and I want risk associated with a CFD contract, whether or not I choose to deposit collateral and mint these two and then sell one of them, or just go onto the market and buy it, is that just a question of which is like cheaper to do, or is it a question of what the collateral type's trading against versus? It's probably more like what's cheaper to do, right? It's like an arbitrage decision.
Yeah, I think they can be equivalent if it's correctly priced. But yeah, it might be cheaper to mint and sell one side. I mean, I think it's a bit more nuanced, because if you mint and sell one side, then you're holding risk on the other side, versus if you just buy one side, like you have, like the risk is not necessarily the same. But yeah, I do think there will be like optimizations where, you know, you could have routing where we might do specific things like this, where you would, like, if someone wants to simply just go long the Apple stock, right, we might mint them the long and the short side and sell the short side, right, and they're just holding the long side. Like there are ways, I think, that you can combine this, and it's all going to depend on like what is the token trading at in the market, and what does it cost to mint. And I think that actually touches on like an important point that by definition, the sum of the long and the short tokens, the value that those are in a DEX must always be equal to the value of the collateral currency at the rate of collateral per pair. Because if it's not, then there's like an immediate free arbitrage. So if one of the tokens is trading cheap, for example, then you buy that token that's cheap, you buy the other token that's at the money or like whatever, it's correctly priced, and you just, you immediately redeem them for the collateral and you walk away with a profit and you can like unwind. So there's quite strong like heuristics around the sum of the two tokens always being worth the collateral. But I think one of the open questions and things that we'll talk about later is like how you actually correctly arb one half versus the other half is like a bit more complicated. But yeah, so that ended up being a bit more roundabout. But yeah, so I think there's a lot to explore in terms of how you can more efficiently market make.
Just a quick question here, Chris. On create, isn't it more generalized if you can actually specify some sort of like weight rather than having the long and short tokens equal, but specify like some sort of weight there? Like by default, maybe they're equal, but then like if you specify an offset, you like you're kind of saying that, I don't know, you're like more long than short or more short than long or something like this. But maybe that's kind of what you're talking about, where there's like an immediate arb. I'm not sure.
I think you could only do that if you like immediately sold some of them. Like I think like from the contract's perspective, there needs to be equal number of long and short to make the collateral per pair whole. Like if you wanted to mint like 20% long and 80% short, like I don't think it would work with the way that this math is designed. And I would like some input from other people who know more about this than me, but I'm pretty sure that like you wouldn't be able to do that in this kind of contract design, because you basically like you're gonna make the whole system like unbalanced. And like part of the reason that it works, that the actual like underlying math works, is because of this balance and the symmetry between the long and the short side. So I don't think you could do that unless you like had a wrapper where you mint equal sides and then immediately sell one of the halves. But yeah, would be curious.
I was just gonna say maybe one way to frame it is like through a lot of these financial contracts, Maker, Compound, like a lot of the financial contracts that exchange risk across the DeFi ecosystem, including the EMP and this one, is that every long needs an accompanying short. So if I get risk that says that I make $1 every time Apple stock goes up, I need somebody to actually be on the other side of that trade and pay me $1 whenever Apple stock goes up. Otherwise, there has to be somebody over there willing to pay me. And every one of the DeFi protocols has like a different way of setting up these offsetting risks. But at the end of the day, for any sort of contract like this, you need that offsetting risk. So the reason that I can't create 80% short and 20% long is that 60%, the 60% that isn't matched by a long, there is no long to be on the other side of that. So then I will have short exposure, but there's nobody to pay me when at the end of the contract, when everything expires. And there are different ways you could like work around that. Like you could design different protocols, but like at the end of the day, you need somebody to pay up at the end. And finding that person, you'd have to design a different contract to have a different way of sourcing that capital. Does that make sense, David?
I need to think about it some more. I'm not quite sure.
Well.
Okay, so what we'll do is we'll go to the next slide and talk about how settlement actually works. So this is kind of that equation we saw on the previous slide, but just digging a bit more into this. So the settlement price informs how much collateral each long and short token is redeemable for. And you could redeem these in a pair if you wanted to, but the whole point at settlement is you could redeem an unequal number of long versus short. So you might have a few long, a few short, you might just have one side or the other, it doesn't matter. And the redemption value is basically calculated using this equation. And I just put it in this form so that it's just easy to follow. So the long collateral redeemed is however many long tokens you're burning or redeeming, times by the collateral per pair, times by the expiry percentage long. And the short is the same, just with one minus in the expiry percentage long part of the expression. And I think the important thing to note here is if your expiry percentage long is 0.5, so it's right in the middle, then the value of the long tokens is worth short tokens. And you get some symmetry from that if it's settling right in the middle of the band. So the question and kind of what we've been leading up to till this point is, how do we calculate expiry percentage long? And I think the whole point of this is that very much depends on the kind of financial contract you want to build. So as long as you can calculate a number between 0 and 1 for a given payout condition, we can build a contract for difference on that kind of product. So like the four primitives that we'll discuss later on, like all of them map to the same thing, where we just, like, given some properties of financial contract and some like settlement logic, can we find a number between 0 and 1 that will divvy up the collateral between longs and shorts, where, you know, if it's completely neutral, the longs get half, the shorts get half. As it favors the long side, so the number goes above a half, tending towards 1, and as it favors the short side, so it goes below a half, tending towards 0, and just mapping the financial contract into that criteria. So the first and like the simplest example is a binary CFD. So this might be for like a binary outcome on a bet on a price, or it might be on a real world event, whatever the case may be. And we can define a strike price in a simple example where we basically look at whether or not the settlement price is above or below a strike price. So if the settlement price is above a strike price, then the long tokens are worth a full, like each long token is worth 1 unit of collateral per pair, and the short tokens expire worthless. And equally, if the settlement price is less than the strike price, then the opposite is true, where the short tokens are worth collateral per pair and the long tokens are worth 0, right? Pretty intuitive. So we basically get this equation for the expiry price as a function of the expiration price. The expiry percentage long is a function of the expiry price. So we can create a very simple example where we create a binary bet on the price of ETH at $3,000, and we can set the collateral per pair to be 1,000 USDC. So if the price of ETH is greater than $3,000, then each long token is worth 1,000 USDC, and if it's less, then each short token is worth 1,000 USDC. Pretty simple. And we can basically plot the payouts that look like this. If the price is less than 3,000, then all the money is in the short side. And if it's greater than 3,000, then all the money is in the long side. And we have our expiry percentage long, which basically is like a step function piecewise from 0 to 1. Pretty simple. And I think that this, you know, kind of encompasses like the simplest case where you can encode like a very simple if this then that kind of logic on the payout between a 0 and 1 binary outcome. And I mean, this, you know, this encompasses like all prediction markets, and there's a lot of stuff you can do with this, which is pretty cool. So I mean, you know, we could look at the same thing with did France win the Soccer World Cup, and create the same kind of payout structure where it's either worth 0 or 1, depending on if they won the World Cup or not, and then you just assign all the value either to the long or the short side. The next product is a linear CFD. So this is kind of like the Apple stock that we were discussing before, right? Where you have a low bound and a high bound. And basically the linear CFD works by shifting how much payout goes to the long side or the short side, depending on where the settlement occurs within the price range. So we define an upper bound like we did with the Apple stocks at $30. And if the price at settlement is greater than or equal to the upper bound, then obviously the long tokens are worth the full collateral amount, the short tokens expire worthless. And the inverse is true, where if it's less than the lower bound, then the short tokens are worth the full amount. And we can define the value of this split within the range just using this equation, where we basically find like where in the bound did the price sit. And we can create like the same kind of graphs, or we'll make an example, then look at the graphs. Where we can create a linear CFD on the price of ETH, where we can set the lower bound to be 2,000 USD and an upper bound of 4,000 USD, and we create the collateral per pair to be 1,000, and the collateral currency is USDC. And yeah, we can see that if the price is less than 2,000, then the longs expire worthless. Each short will be worth 1,000. If the price is more than 4,000, then the shorts expire worthless, and the longs are worth 1,000. And if it's anywhere between the two, then we can basically calculate how much each long and each short token is redeemable for. And you basically get a payout structure that looks like this. So on either extreme, the long or the short sides are worth the full amount respectively, and your expiry percentage long is a linear line between the lower bound and the upper bound. And that point that we were discussing earlier on, where you're right in the middle, that's right when the price is equal to the midway point of the range. So that's pretty cool. Any questions, or should I go on to the next one?
Does it need to expire worthless, like if it's beyond one bound, or could you define other floors and caps?
Sounds like a range bond, Sean.
Nice.
Yeah. So you can define like different kinds of like logic on the ends. Like you could limit what the maximum or minimum amounts could be on either side, and you could just like you be as creative as you want really with that payout function. But yeah, in this case, it's worth 0. So.
And
yeah, but we'll
I'm also assuming that you can just transform prices in the same way that you can do with like an EMP, right? Like say you wanted to create like a 2-time like leveraged ETH product here instead of just like betting on the price of ETH.
Yep. Yeah. I mean, you could just modify this equation, right? But I mean, by definition, I think there is leverage in this, right? Like you're going to be buying exposure that's larger than the cost that you're putting down. So it does have implicit leverage, but yeah, you could modify this equation to encompass any kind of multiple on this. Like you could have like a weird thing where it's like twice the long exposure and half the short exposure or something, and then it would be steeper above the halfway point and shallower on the other side. Like you could create wacky products like that where you have like nonlinearities, right? Like maybe a sigmoid would be an interesting shape to put here. I don't know. There's lots of space to explore with defining that function. Okay, so the next product is a covered call. So we've already built covered calls using the EMP, but they were pretty janky and had problems. So using a CFD enables us to like remove a lot of these problems. And basically the way the covered call works is we just define a strike price, and if the settlement price is above the strike price, then whatever the value is above the strike price is paid out to the long side, and that's the fraction that's above the strike price, and the short side gets back the remaining part of the collateral. And what's important with these covered calls is that they're actually collateralized in the currency that the option is actually written on, and that has some cool properties like not needing to recollateralize them, because you basically can accommodate like all possible outcomes of the settlement price can be covered. So for this, we have this expiry percentage long is equal to the strike price, the expiry price minus the strike price divided by the expiry price, assuming the option settles in the money. If it settles out of the money, so below the strike price, then it's just 0. So each short token is worth the full collateral per pair, and the long tokens expire worthless. So we can create a covered call on the price of ETH using the same strike price we had before of $3,000. And we can set the collateral per pair to be 1 WETH. And what's important here is that it's in WETH. So you need the collateral to be the same currency. So if the price is less than 3,000, then each long is worth nothing, and each short is worth the full collateral per pair, so 1 WETH. And if the price is more than 3,000, then the long side is worth a fraction of collateral that was actually in the money, and the short is worth the remaining. So if the settlement price was 3,500, then we can calculate the expiry percentage long using this equation. And this number, 0.143, multiplied by the price of ETH at expiry, which is 3,500, gives you the value of the collateral that was over and above the strike price, which is 500, right? The strike price was 300, and we settled at 3,500. So the difference between those is 500, which is what this equation gives you. And this is exactly the same payout structure that we have with our current call options built on the EMP. And we can see that the payouts basically look like this. So the first chart is the ETH payout denominated in ETH. So if it's below the strike price, then the short tokens are worth the full amount. And as we go above the strike price, so the long token is entitled to some ETH. And if we look at it in dollar terms, the loss or the amount that the long side gets back increases linearly after the strike. And the short value is capped at 3,000. Basically, like all the upside above the strike that the short would have been entitled to is given to the long side. And that's very much how options work when they're in the money. And the expiry percentage long we can see is just trending up according to that function that we defined earlier on. Okay, any comments on the covered calls?
So in that second graph, the short is not showing the profit they got from selling the calls though, right? That's in addition to this?
Right. This ignores the premium that you would have sold the calls at. This is just the settlement cash flow. Okay. And I mean, if you were to plot that part in, then the long value would start negative, right? Because you down the premium at the beginning, and your break even would be the strike price plus your premium that you paid.
Gotcha. Yeah, they would just shift the same.
Exactly. It's like a DC offset on the graph. Okay, so range bonds. So we've looked at 3 products now. We're now going to look at the range bond. And the range bond's a bit confusing. And I think it's easiest to when we actually look at the payout graphs. So it's when you actually can see what the payouts look like as a function of expiry price, it becomes a bit simpler. But basically, the range bond is a combination of a yield dollar, a short put option, and a long call option. And what this means is there's like 3 discrete products that operate over different ranges of the payout, possible ranges of the payout price. What the yield dollar is basically like a bond that pays out a fixed notional at expiry, right? That's the same way that our current yield dollars work, that are $1 denominated, but the notional of the bond could be any number. The short put option caps the maximum losses denominated in collateral that the token sponsor or that the minter could take on. And this is important because if you had a yield dollar, let's say collateralized in YAM, and the price of YAM dumped like 1/100th of what it is now, the token sponsor that let's say is like the YAM treasury, they would need to keep topping up their position to make sure that they don't get liquidated. And that basically means that at the onset of them selling these yield dollars, which are basically like bonds, they don't have a cap on their maximum losses in YAM denominated. They know what their maximum losses are in dollars because that's like the bonds that they've sold, but they could lose like an unlimited number of YAM if YAM goes to 0. So the short put basically limits the maximum losses that the sponsor could take on at a fixed amount that they know beforehand. And we'll see what that looks like on the plot. And what the long call option enables is that if there's any long or any large positive market movement, rather than just receiving a fixed payout of the bond notional, there's a point by which any rally past a certain amount will actually entitle the token holder to receiving some profits from that rally, which is quite cool. So it basically incentivizes like passive investors to want to hold this asset if they're bullish on it in the long run. And if they like kind of neutral about it, then they're going to basically collect a premium on the bond. So the way that we define this, taking screenshots from Kevin's document, is basically a range bond is a yield dollar minus a put option. So that means a short put option plus a call option. And we can numerically define this using a few variables. The important variables to note here are the bond notional N, the price of the token, which is the settlement price, the number of tokens T. So that T is how many tokens the long side is entitled to at settlement as a function of the settlement price, the low price range and the high price range. So don't worry about this equation just yet. We'll get to an example and it'll make more sense. So if we consider an example of a range bond where we collateralize it in USD in UMA, this is wrong. It shouldn't say collateralized in USDC. It's collateralized in UMA, and the bond notional is set to $100. The low price range is set to 10, and the high price range is set to 50. So what we can do is at settlement, we can calculate how many tokens the long side is entitled to by taking this equation and popping in those numbers, and you get this equation. And this will make sense when we look at some payout charts. So I want you to first consider the top right chart, where it's range bond CFD long payout versus price in USD. So this is the most important chart to look at, because this is the chart that the token holder, the payout that the token holder will receive. So if the price is anywhere between the low range and the high range, which was 10 for the low range and 50 for the high range, the token holder simply gets the bond notional, which is 100. If it's anything less than the low range, which is 10, then the long side gets a fixed capped amount of UMA, which in this example was 10, and this line slopes downward because the price of UMA is dropping, but they're not receiving any more UMA. At this point, they receive the maximum UMA, which is 10. And that also caps the maximum losses that the sponsor will take on as being 10 UMA. If the price rallies past the high level, then the long side receives a minimum amount of UMA, which is then rallying as the price goes up. And we can see like how the collateral, the number of UMA, is shifting over this range. So if the price is less than 10, looking at the green line here, we can see that the maximum number of UMA that the long side will get is 10, right? And that's the maximum loss that the short side will also take on. And equally, when we hit the upper bound of 50, the minimum UMA that the long side will get is 2, right? So basically, this is the payout graph that they're expecting, and this is how much collateral is shifting between the long and the short side as a function of the price. This plot is the same as this plot, just including the short side. I included the long side separately because the short side kind of dwindles the long side, making it a bit harder to read. And the expiry percentage long is basically just showing how the value is shifting between the long side being fully in the money at the low price, or not in the money, but having all the collateral entitled to them, versus the long side having only 0.2 collateral entitled to them over here. Okay, so I know I went over that quickly, and I would love for Kevin and Hart and Matt to comment on better ways to understand this. But yeah, for me, the best way to understand this was this graph, and actually working through the different regions in this and under what scenarios you would enter those regions.
I think you did a very good job.
I agree.
Yeah, I think you explained it better than I could have.
Cool. Any comments? Okay, cool. Thumbs up. It's fine.
You know what I will underscore and highlight is the point that the issuer here, if a treasury is issuing this, they need limited downside. So your point that you very clearly articulated, I'm just underscoring it. It's like if a treasury were to try to issue a bunch of yield dollars like collateralized by YAM, and YAM went down 90%. They have to keep topping up their position, and that's very problematic. It doesn't really work from a treasury management perspective. So the put option that is embedded in this, the limited downside, the fact that there's a maximum amount of tokens they ever have to pay, is really important if this is going to be used as a treasury management product. I think that's like a really important point to make. So the treasury really wants that put option. Then that means the buyer of the range token is short this put option, and to compensate them for that, we're going to give them a call option so they have upside. That's kind of the way I look at this is just another way of kind of looking at it. So it makes sense why the seller wants the put option, and then it makes sense that why the buyer, who doesn't particularly want to be short this put option, we're going to compensate them by giving them a call option too.
Another way I like thinking about it is if you kind of squint your eyes at that top right chart, it kind of looks like just a linear thing, like a curve that looks like this, right? And what I think is cool is like it's worth $1 while the price kind of sticks around where it is now. Like you're kind of getting that dollar payout, but under wild price swings, basically the person on the long side, like the person buying this thing, ends up just kind of being exposed to the asset. So like if I bought this for UMA, as long as UMA doesn't either crash or go or boom, I'm I'm gonna get my dollar. But if it booms, I make a lot of money. If it crashes, I lose a lot of money. So I'm kind of at the only exposed as a buyer. I'm only exposed to the tail risk of UMA, and I'm like not exposed to like the day-to-day price swings, which is, I don't know, like depending on your risk, like type of risk you want to take on. That's, you know, I don't know, but like it's an interest. It's like a sort of payout structure I've never seen as a buyer, like where you're only exposed to tail risk and not really exposed to like day-to-day small percentage moves.
Awesome. I have another plot which was stolen from Kevin's document, and I basically annotated it. So just to try and like go into how the math works in different ranges. So this equation T, like we said before, defines how many tokens how many tokens in collateral the long side is entitled to. And we can see this is the same plot as before, where we've got the USD amount being anywhere between 0 and the bond notional, and after the cutoff price at 50, it becomes a long exposure of 2 tokens. And we can see that there's like 3 discrete ranges here, and you can calculate what the payout in collateral will be. And I think it's easy to think about this in units of collateral. So if it's like less than the lower bound, then the payout is just fixed at 10 collateral. And that's taking this equation and basically putting in numbers, and you can see that, you know, the minimum of N over P and N over R1, if P is less than R1, then this just dissolves down to N over R1, and the max of this just dissolves to 0. So the number of tokens entitled to the long side in this region is just 10. And we can calculate the expiry percentage long by just taking this equation and then dividing it by the collateral per pair, which in this example is 10. So it just becomes 1, which is what the plot before said. And then in this region, we can do the same kind of exercise, plugging in numbers. This thing also dissolves to 0. And then this thing just turns into N over P, which is the payout of a bond or the range for the yield dollar. And we get 100 over P. And what that means is the number of tokens will be redeemable for the bond's face value, the $100. And we can calculate the expiry percentage long just as being a function of the price in that region. And then in the last region, it's the same kind of exercise. We just can see that the number of tokens is equal to the yield dollar component plus by the call option. And you get a minimum amount of collateral being 2, and your expiry percentage long is 0.2. Okay, so yeah, that just kind of goes full circle in that equation. So finally, that's it on the full product. And the final thing to discuss really is some of the complexities and open questions that we haven't really solved necessarily for the CFD. So first of all, market making is pretty difficult, right? And I think like this was one of the big issues that the market protocol had when they launched CFDs in like 2018, is like actually providing liquidity on these things, and hedging the risk is complicated. And also there's like a lot of complexity. Like what happens if one of the bounds are hit during the lifespan of the contract? Like how do the market makers trade this? I think Uniswap v3 could help, where we can put like basically limits on what range will provide liquidity over, but it's not like immediately obvious how that's solved. How you can bound the error on the long and the short side tokens like pre-expiry, and actually looking for like natural arbitrages is also quite difficult. Like finding an arbitrage for pairs of tokens is simple, but individual tokens is hard. This might not matter. It might just trade like an EMP, which trends towards the true price as we get closer to expiry. But I don't know. This is one of those questions that I'm not really super clear on. Other thing is that these linear CFDs have like non-linear leverage relationships over the bounded range. So as you move closer to the one side or to the other side, there's like an implicit leverage that you're taking on. And this is like quite difficult to reason about. And I think it becomes complicated for people that might want to buy the token. If it's anywhere not near the middle, it's like not immediately obvious what kind of risk exposure you're taking on. And also the capital efficiency changes as a function of how wide the ranges are. So the narrower the range is, like the higher the implicit leverage, because it costs you less capital to create the position, but it also makes the product more difficult to actually interact with because it has a higher likelihood of hitting the ranges. So these are just some of the like problems, and well, not problems, but open questions and things that we yet to really sort of figure out with the CFD. there are many others, but these were just some that I wanted to mention. Yeah, so I think what would be useful to discuss is like other products we could make with CFDs, and maybe just talk about ways that we could extend the design and just general feedback in the like 1 minute and 10 seconds we've got left, I guess.
I mean, I think we can go over, I do have another call, but one thing I was going to say around just your open questions, Chris, is I think the clearest use case here is if we're doing things that avoid requiring markets, at least after they're initially created. So it's like, I think the use case, like KPI options don't really require a deep liquidity after this. Range bonds, range tokens could like require liquidity right when you first issue them and they're trading around $1. And then maybe there isn't liquidity until expiry. I think there's lots of, that's just one thing that I want to sort of plant a seed where it's like, maybe the right products we focus on are things that don't really require a lot of liquidity between initial creation and expiry. Because these are very real questions and hard problems.
I think that the one thing I didn't conceptualize until this call was the third point you made here, Chris, which is that the nonlinear leverage. Like, I think there's like a cool way to think about this where if you're really close to one bound, like if the long is already like at 99% of the value, right? There's like you're only, if you buy the long, you only have the chance to gain like 1% from that point. So there's like not a big incentive to buy along there. And people have seen these with betting markets, like on the election. Like for instance, in the US election last year, like after the election ended, there was, I think a few people, Vitalik had noted this, and I think Nate Silver noted this as well, where after it was clear that Biden had won the US election, there was like still like a 10% or 11% chance that Trump was going to win the election on betting markets, that he was going to be inaugurated. And it was, in part of it was because of some of the uncertainty around the election, but I think a lot of it was because there's not a big incentive to buy up a long token for 90 cents if you only have the opportunity to make 10 more cents on that position. Whereas the incentive to buy a short token for only 10 cents where you can make 90 more cents, you have way more leverage there. You're paying way less for a much bigger opportunity for gain. So it's like a really cool, there's like this really big I don't know if nonlinearity is the right word, but like shifting of like incentives as the price moves towards one of the bounds. And it gets really extreme as you get really close. So that's a really great point, Chris. I just wanted to emphasize.
I think that also, like with the election thing, like there was a long time until settlement potentially. Like it was, I think it was the inauguration date. So there was like a cost of capital as well that you need to factor in. So MC DEX.
And just people people would actually sell out of the long positions. There was a lot of sell pressure on the long because they wanted to get out and just make the 90 cents and not wait for the last 10 cents because it wasn't worth it. It's a great, that's another good point.
Yeah. So MC DEX was, which is now like they do like perpetual swaps and things like those. They originally were built on market protocol, like in 2018. And you could see in their interface, like they traded ETH CFDs. And you could see like as the price moved to either side of the range, you could like see in their interface how the leverage would increase or decrease. And it's like, it's pretty extreme. And like with their product, like they would settle every week, and they would basically roll into a new CFD every week to kind of avoid this, because you ideally want it to be like as close to the middle as possible when you enter. If it's as it moves further away, like this implicit leverage just becomes really whack. So yeah, I think Hart's point around like avoiding this hard problem by not like focusing on the specific product will help a little bit with that in the beginning.
But we still want to make the range bonds. So we're either us or someone's going to have to solve this market making problem for the range bonds. And I guess that's sort of a follow-up thing to think about, like how do we provide liquidity on range bonds properly?
I mean, if we go back to this chart, right, the leverage over this range like becomes like exponentially worse as you get closer to these bounds. I can't even think what the leverage is going to do as we traverse this range. Like that's going to be some other even whacker nonlinearity. Like if the range bond is like at like just before the point where it enters the call region, like it becomes even more complicated. So yeah, you're completely right, Nick. Like this is going to need to be solved in some way. Otherwise, I guess the person who's selling it and on the short side just like tanks the losses. I mean, I'm not really sure how you resolve that easily.
Yeah, I think the seller of it is like it's naturally like the DAO or someone who has exposure to the underlying. I think I was talking with Hart about this at launch, like the much harder side is like who's buying these things and are there ways for them to like reduce their exposure potentially? Like if you think about it, if you're long a range bond, you're short a put and long a call, and you could theoretically try to break apart that exposure and hedge it with various counterparties somehow. Like for example, some parties that could be involved somehow would be like some sort of like vault operator like Ribbon, who could be a counterparty, or maybe like some hedge fund who wants to go long a call but doesn't want to short a put. But I think there's potential to like piece together the exposure such that a buyer of a range bond can drastically reduce the risk, maybe even just reduce it to a yield bond.
Yeah, I think that's right. Like, but with what Ribbon's shown is that there's a lot of people who are willing to sell optionality to pick up yield. So there's some parts of it that the market definitely wants. Like people right now don't care about tail risk and they just want yield. So if there are a lot of people who are willing to sell puts and sell calls, like you could satisfy that demand. And maybe it's a matter of how you package up the buyer. Like I think the big concern is finding buyers of optionality right now, because DeFi just doesn't care about that. They only want yield, and they're willing to do it. They're willing to take a lot of risk to get that yield, but nobody wants to buy the optionality, or they don't know how to trade it.
Yeah, because I guess everyone in the space is long vol inherently.
I guess so. Well, they think they are, but I guess we're also short a lot of vol too, right? I mean, we own very volatile products. Like we're sitting on a lot of volatile assets, all of us.
Yeah.
I also going back to that graph, Chris, if you could jump back. I think one of the interesting things here, if you look at the leverage on this top right chart, I think as a buyer of this, I actually wouldn't be super concerned. You don't have that same leverage issue you were talking about earlier, because your payout actually I'm really happy if I'm a buyer of this thing and it's getting close to that right side, because then I start actually getting upward. Again, I'm getting like a call. I'm going to hit the strike of my call, which is really good. It's when you get close to that bottom side that it gets really weird as a buyer. So it actually has a really different leverage, quite a different leverage structure than the other product you mentioned, because my payout is no longer capped in dollars like we talked about in the other one. My payout is actually uncapped as I get close to that right side.
So maybe
now on the left side, I really don't want the negative price exposure, so I might get nervous as a buyer if I'm getting close to that left side. But it actually almost condenses a little bit to like a normally owning UMA or owning the underlying asset. So it might not have as bad, the range bond might not have as bad of properties as the linear CFD that we were talking about earlier.
Yeah, I agree with you on that, because it's almost like the risk profile just changes, and the way you market make them just changes. But it's not as scary as a payout going to zero, and then creating that kind of like sharp difference in risk profile.
Exactly.
Does this maybe have something?
Yeah.
Sorry, Kevin. No, I was going to say, does it maybe have something to do with if the product is collateralized in the same currency that the payout is calculated in, like the settlement price? So in the linear case, we're collateralizing it in USDC, and we're looking at the price of ETH. Whereas in this, we're looking at the price of UMA, and it's collateralized in UMA, right? Like, would you say that the binary case, like, what is the leverage properties on the binary case, like that, because it's got the same not the binary case, the covered call, right? Because the collateral is the same as the price of the identifier. Like, does that influence this? Is that the rule almost?
Yeah, I don't know how to exactly describe it, but yes, you have exposure to the asset. Whereas in using USDC, like you just have this, you basically can exhaust the collateral, and it just goes to some bound that becomes 0. Whereas with this collateral and this payout, I don't know how you describe it, but like it doesn't sharply go to 0 effectively, and you just end up having exposure to the product. But I for range token, it's almost like I'm calling them range tokens now because bonds might be bad in a regulatory standpoint. But in a range token, it's kind of like you would buy a range token almost like the same reason you would buy a credit bond, like a credit. If you believe in this project and you believe that it's going to survive and it's a long-term project, then you're okay buying that token when that put is struck, when you exceed that put, because you're saying like, well, if this token really tanks 90%, I'm happy to buy it, or I believe this project's not going to go to 0, and I'm happy with it. So it's almost like you believe, like say if you bought a corporate bond, like you believe this thing's not going to default, and you're willing to buy that bond, and then you also get that kicker of that call. And I think so there may be buyers that may think about it like that. And if you really want yield, like you could imagine, like say it's like a Uniswap bond, and we strike them like a $10 price and a $50 high range, and we also have a call market with $50 calls. You can imagine people wanting to just pick up yield. They could buy the range token and then they just sell the call out, and then they purely just have massive amounts of yield, and they're willing to sell that put because they believe, like they would be willing to buy Uniswap at a $10 price or something like that. So there's different uses for it, I think, but maybe we just have to find ways of marketing it and advertising it to people.
Yeah, that's pretty awesome. I'm curious what other than the 4 products we described now, like what are the other products, Kevin, you think are like would be the next most obvious things to look at building and like that fit well within the structure?
I don't know. I feel like with these 4 different variations, you could probably build a lot of stuff already. And all of it is just tinkering around with that payout or that percentage long. I think is what you call it, right?
Yeah.
I think you can do a lot of different things with it, but you just have to be conscious of the risks that you create out of that payout.
Are there other types of options that we can build? Like we have covered calls and we have this range bond. Can we build? You can't, and I'm guessing you can't create a full option portfolio, can you? Maybe you can. I don't know.
I think you could. It's just like we can create put options, for example, and call options. Like the put options is less of a natural minter of them, I guess, because for a treasury, because we would have to put up stable coins, I think, in order to do that. Whereas if you do call options, we're just putting up our own native tokens to do that.
Right, but you could create put options as long as they're settled. You might just have to change the settlement currency.
Yeah,
or the class.
Great. Yeah,
that makes sense.
Mm-hmm.
Awesome. Well, if there's no other comments or questions, thanks everyone for sticking around and staying 10 minutes over. This was actually really good, I think. I enjoyed it. Yeah, thanks.
Yeah. Thanks, Chris. That was great.
Yeah, thanks, Chris.
Yeah, that's awesome.
Great job.
Thanks, Chris.
Well.
Cheers.